All right. Welcome, everyone, to another Tower Wealth Advisory podcast. I'm Tyler.
I'm Dave.
And we're joined by Jeff Krukoff from Dynamic Mutual Funds today. He's live here in our presentation area today. So thanks very much for joining us, Jeff. I'll turn it over to Jeff in a little bit here to introduce the portfolio manager that we'll be speaking to today, a gentleman by the name of Frank Latshaw. Frank's going to be speaking to us about the infrastructure space and some of the key themes that are driving infrastructure investing today. But before we jump over to listening to Dynamic, a couple of housekeeping items. Just to let you guys know, there's no formal presentation today. It's going to be an open-ended question format where Dave and I and Jeff as well are peppering Frank with some questions about the infrastructure space and hearing his feedback on it. Frank's going to be with us. Hopefully, he's just hopefully signing in right now, but he'll be with us for about half an hour. So we'll spend 20 minutes asking our questions. We'll probably leave 5 to 10 minutes available for our viewers to ask questions, and then we'll let Frank run after about 30 minutes time. He's got other activities that he needs to get off to. So we've got Frank on the line right now. So I'm going to turn it over to Jeff here. Frank, thank you very much for joining us. I'm Tyler. I'm Dave. You just missed our brief introductions. I'm going to turn it over to Jeff, and he's going to do a brief introduction of Dynamic as well as of yourself, and then we'll turn things over to you. So, Jeff, if you could introduce yourself and Frank, that'd be great.
Perfect. Gents, thanks for the invitation to join you, and thanks for those of you tuning in at home from the comfort of their home or office today. A little bit of background about Dynamic Funds. We actually started as an investment club, and we were formed in Montreal back in 1957. So, it's one of the stories I always like. There's a bit of a joke that kind of makes the circles that we started over $5,000 and a pound of smoked meat. So came from humble beginnings to become one of Canada's largest and most recognized wealth managers today. And I think that's relevant in a world where we're talking about things like crypto blow-ups and all those things out there. I don't want to dovetail too much about that, but really we manage money on behalf of Canadians. And I think one of the things that's extremely important to us is we believe in the value of advice. And in fact, our tagline is invest with advice. So it's our belief that Canadian investors should be working with professional investment advisors, financial advisors such as yourselves to help secure their futures and the best possible outcomes. And so we partner with investors and directly through our advisor channel. So thank you guys for being there to partner with us and to help guide your clients and your investors through everything that we've been dealing with and probably yet more to come. Frank, thanks for joining us today. Great to see you on the screen. I think we've got you okay now. Just a quick background on my colleague Frank Latshaw. Frank is vice president and portfolio manager with Dynamic Funds, and he really provides his experience in the infrastructure space to focus on investing in attractive companies that own high quality assets. Frank joined Dynamic in 2011, and previous to that brings another 12 plus years in the business. Frank received a Bachelor of Commerce degree from Queen's University. He also holds the Chartered Accountant, Chartered Business Valuator, and Chartered Financial Analyst designation. So certainly does better on tests than I have previously. So quite the background. Frank, thanks for joining us today.
Yeah, well, it's certainly my pleasure. Y'all can hear me okay? Yep, good.
We can hear you, we can see you.
Good. No, apologies for being a couple minutes late there. I actually did do a test run and it worked fine. And then when I went to the live performance, the link didn't work. So I had to shut everything down, which is what our tech department has taught me years and years and years over time, is just shut everything down and start it up again. So thankfully I made it, and it's a real pleasure to be here. Thanks for that, Jeff, and thanks to you folks at Tower for having me. So I'd be delighted to have a conversation with you about infrastructure and answer any questions you may have.
That's great, Frank. And thank you for being here. We really appreciate it. We've got a little bit of feedback coming from your end. Hopefully it clears up a bit. There's a bit of a delay and some stuttering, but we'll just push forward and hope that the technology works itself out. We do have a few questions for you on infrastructure in that space, and our attendees, of course, are going to be interested to hear from you on it. There's been some strong performance out of the infrastructure space. So we wanted to learn more about it, and we wanted to bring it in front of our clients and our prospects and our business partners to learn a bit more about it. So how do you define infrastructure, and why are these assets attractive to investors today and going forward?
Yeah, I think it's very important to stick to a very disciplined definition of infrastructure, because if you do, I think you get, some very interesting characteristics in your investment portfolio. And, yeah, I've learned over the years that you kind of have to be comfortable with being, not the most exciting guy in the room when it comes to portfolio discussions. Boring is good, right? Boring is definitely good. And I think quality companies that provide essential services, which I think is the key definition, right, of what an infrastructure company is. It's a company that provides an essential service to society that we can't live without. And what that usually means is over time, you get a nice, stable, steady, predictable return. You're not going to shoot the lights out in a raging bull market. You should do better in a bear market because the fundamentals are just so stable and steady. And then I think one of the other appealing things to the infrastructure space, if again you've properly defined it, is these are companies that have over time either underinvested in the assets and services that they provided, or they simply just need to build new infrastructure to meet society's changing needs, and that spells long-term growth. And I think when you look at historically how much money has been spent on infrastructure, benchmark it against GDP or some other relevant measure, you can see that the past 10 to 20 years we haven't spent as much as we needed to just to sustain a basic standard of living in a number of areas. And so there's a undersupplied aspect to this industry that I think is perhaps underappreciated. When people think of infrastructure, they think of, I'm just colloquially, bond proxies, right? Which is true. These companies do have stable, predictable income streams like fixed income instruments. But unlike fixed income instruments, they can actually grow not only with inflation, but inflation plus, because they do have to build out their asset base to make up for lost time in the case of those that underinvested, or in the case of something like renewable power, we just need to build a lot more capacity that it doesn't exist yet. So it's this interesting combination of companies that provide services we can't live without, that have long-term growth, kind of feels like equities, and then has the predictability and stability of a fixed income stream. So kind of like bonds, not really either, and therefore something that's a bit different and I think quite intriguing.
Obviously with it being a bear market that we've been in, an area that's attracting a lot of attention right now. Dave, you want to fire off a question? Or?
Yeah, I think obviously this is a type of investment that's been mainly used by pension funds, insurance, things of that nature. I know it's been available a while to, say, retail investors or our clients per se. What are you looking at right now? What types of things are you excited about in the fund, and what's kind of setting maybe your fund back? What are the headwinds that you face?
Yeah, so it's interesting. First of all, to address the pension comment, I think that's a really good one, and I think infrastructure has been a fairly significant allocation amongst the pension guys who are, their job is to allocate capital to meet future retirement obligations, which is I think a lot of what you guys are doing. So I think it's a relevant comparison. The difference is the pension guys rely on very low cost of debt financing, and they typically don't look or need growth. They can just buy these things levered and a cash on cash yield of 10%, and they're happy, or 8 to 10%. In the listed space, I kind of need to have several drivers of total return. So I need to have a good dividend yield. We're minority shareholders, so I don't own all the cash flow. I need long-term growth potential. And then if I'm lucky, or if I can buy things at a good price, I get multiple expansion too. So three drivers of growth that I need to work for, being a listed infrastructure investor versus a private pension one. Now, in terms of what excites me, there's a number of long-term secular themes, in particular within infrastructure, that I think is going to drive a lot of interesting growth. And one of them is aging infrastructure, which I talked about, underinvested. Another one is climate change, where I think there's going to be an ongoing need to invest in energy type solutions. The biggest one would be renewable power, and then a third one I would say is onshoring or reshoring of manufacturing and production capabilities, and certainly two of those long-term themes, which when I say long-term, I mean like the next 10 to 15 years, these things are going to be around. Those two, replacing old infrastructure and climate change, both of those themes intersect over the power industry. So regulated electric utilities and renewable power developers are both going to be benefiting from those key drivers. I would also say onshoring and reshoring touches them too, to the extent that more battery storage and solar production capacity is brought back to the United States and North America in general. That's sort of a security of supply thing. That's an added benefit, but that should benefit the industrial areas of infrastructure too, around transportation, primarily toll roads and railroads. But I think there's an underappreciated case to be made for the best risk-adjusted returns in infrastructure being regulated electric utilities. That has typically been the lowest risk end of the spectrum for infrastructure because they're regulated entities, but now they have some of the healthiest growth because of this replacing old infrastructure plus climate change opportunities. So replacing coal-fired power with renewables and firming up transmission and distribution grids it spells a lot of growth for these companies that are, for all intents and purposes, the safest parts to reside within the infrastructure space. So I very much like the power sector.
Okay, so what's in the infrastructure side of things? What's not doing so well? Where would you say if you were developing out a portfolio? Obviously, you'd be strong on the electricity side of things. What's waning a bit here then?
Yeah, so this is a case where I actually got it right and it still didn't work this year, and that was the recovery of air traffic and travel. So I had upped my allocation to the airport sector earlier on this year and into late last year, thinking that as we reopen and people get back to traveling again, on a more gradual, measured basis, we're not going to get back to pre-pandemic levels until at least 2024. But the stocks look cheap and did not price that in. And I'd say the quote unquote revenge travel experience this year has been, it's resulted in a much stronger bounce back of air traffic. But the stocks are just kind of looking through that and looking at the GDP slowdown that's around the corner. So that's an area where my fundamental work actually panned out better than I expected, but the stocks I think are probably still going to struggle until we get through this next leg of economic turbulence. So that's one area. The other area I would say that's not working, not for fundamental reasons, but for valuation reasons, is the communications sector. So cell towers and data centers. So I'll leave data centers out of it because I think there's potentially some issues there that preclude me from going back. But cell towers are fine businesses. These are great companies with extremely strong free cash flow and high barriers to entry. The problem was not anything with the way they conduct their business or the business fundamentals. It was we entered this year where rising interest rates punished even the best companies that had high valuation multiples. And so, I mean, we sidestepped most of that in the communication space, but not all of it. And that has certainly hurt this year. Nothing wrong with the fundamentals, but the high interest rates meant pretty significant multiple compression in the communications area.
Interesting. So I understand how the higher interest rates are affecting that portion of infrastructure investing, but higher interest rates, inflation, stuff that's going on overseas in Ukraine, geopolitical events. How do these things affect a portfolio like yours when you're investing locally almost, or in North America in infrastructure, or globally? I mean, I'd be curious to know how infrastructure is affected because it is such a steady performer, and often under regulation and required to be in place. So how do these events and how do these situations affect infrastructure?
Yeah. So on the geopolitical front, I'd say it's kind of like, the analogy of the butterfly that flaps its wings and it creates hits the water and creates a storm across the Atlantic. And we're seeing that kind of a phenomenon in infrastructure indirectly in the form of sticky inflation, and things like food, energy, and therefore labor. I think these are all areas that you're not going to see a solution from a simple slowdown in economic activity or higher interest rates from central banks. Therefore, that means interest rates are probably going to be higher for longer, and inflation higher for longer. And that has sort of second derivative implications for areas of infrastructure. So it's not directly, like we don't own port facilities in the Ukraine or anything like that, but the simple fact that the backdrop has changed for longer than I think we'd like it to, that does ripple through into the rate at which a lot of these companies can refinance themselves. So inflation being the primary building stone of interest rates. If inflation's sticky, then higher rates are sticky. If higher rates are sticky, then these companies are when they come to refinance their debt, and because they have to build to grow, they have a lot of financing needs, not just refinancing, but to finance new projects, and they have to access the debt markets to do that. So higher financing costs could temporarily impact the cash flows, not materially, but if I'm talking about a sector that can naturally grow 7 to 8% a year, and I tell you interest rates, if they stay elevated, could shave off 1 to 1.5 percentage points of growth. I don't have a lot of chips to play with. That's that's a noticeable degradation of earnings growth for the next couple of years. That's kind of the big challenge. One of the things we do on the equity income team at Dynamic is we make sure that we stay with strong balance sheets. So I'm not worried about the ability to finance themselves. It's just the incremental costs could be a bit of a drag on earnings, at least around interest rates. So I'm most cautious about that over the next little while. Over the long term, that doesn't change a darn thing about the growth opportunities and the total return. But it certainly does put a damper on the 2023 outlook around the edges.
Great. Just want to put it out there. Obviously, we only have Frank here for another 10 or so minutes. So normally we would open up for questions for viewers at the end of our presentation. But at this point, if anybody wants to ask a question, just hit the chat button or the Q&A button, and we'll relay those questions to Frank while we have him here. If not, we'll answer some of those questions after as well. So what else you got there, Tyler?
Just one other question that you're speaking about how interest rates might act as a headwind in the infrastructure space. Why would people today be considering infrastructure in their portfolio, and not just infrastructure, but a managed product like what you manage on behalf of unit holders? What would be your comments to that? As to is it still a viable space even though we're sitting in high interest rates, high inflation territory?
Yeah, no, that's a very good question. And when I talk about the fundamental risks and the opportunities, that's one thing. But the other, I guess, the elephant in the room that's even an even bigger threat to infrastructure is not sort of the economics, it's the substitution risk. So if I'm saying to you guys, I can give you on average over time something like 7% capital appreciation, 3% dividend yield, plus or minus, before fees. That still looks good. It's like a low double-digit total return over time. But if you can get decent investment-grade bonds for 6 to 6.5, then people start to reconsider. Maybe I don't need infrastructure in my safety bucket. Maybe I can go with some high-quality bonds instead. So for me, the biggest risk is not so much my concern about these companies' ability to endure some macroeconomic headwinds over the next little while. It's just basically the less appeal potentially versus some other investments where for the longest time, they didn't really compare at all, bond yields versus infrastructure. But in terms of managing an actual portfolio, as I said, I don't I don't think I look at things the way that the pension guys or the private equity guys do. They just look at how much they can lever a transaction. They own 100% of the company. They just assume they can get a 10% cash on cash yield, and they're happy, more or less. I have to work to get three sources of sustainable total return. One is the sustainable dividend yield. One is a company that's convinced me that they can actually grow at least 7% per year. And then on top of that, something that can maybe at least protect you from further multiple compression, or even better, can offer you some multiple expansion if the stock is not trading anywhere clear its intrinsic value. And the thing with listed infrastructure stocks right now, after the pullback we've seen recently, the valuations are now trading at a 10 to 15% discount to where they historically have over the past 10 years. A little bit less if I extend that historical period back even further to maybe encapsulate a period that's got was typified by higher interest rates than what were the last 10 years. So I'm no longer worried about the multiple compression risk in the listed space, but I still have to be mindful of that, plus the other assessment of growth potential and sustainable dividend yield. And to be honest, that pretty much fills up my day quite nicely. So I spend it's my full-time job to make sure I do that and do it well. And it's not easy. So no, I think it's a combination of those things. The benefits of having a listed mandate versus a private mandate, the fact that I do have to assess multiple avenues to make sure I get the right investments, and on top of that, stay disciplined to owning just pure infrastructure, because I don't think everybody out there does. And you guys can populate a client's portfolio with tech or infrastructure adjacent type stuff, or materials or energy, or things that maybe some infra managers might stretch to try to include in their mandates. You guys can do that on your own for your clients and find the best people to do that, or yourselves to do that. My job is to offer you what I think is the best infrastructure, pure infrastructure mandate. So that's how I would kind of try to justify my existence in the ecosystem. Is I got a disciplined approach, and I think I can still offer pretty good long-term total returns, but it takes work.
Yeah, that's something that I know Dave and I appreciate. We're portfolio managers as well. So when we construct a portfolio, we do look for pure mandates, as you mentioned. So we don't want a bunch of drift or people, looking for a little bit of a boost somewhere else outside of their normal mandate. So we do appreciate the construction on that standpoint. I know we're bumping into the end of your time with us, Frank. So Dave, have we seen any questions from our attendees?
Just Frank, maybe the regional mix in your portfolio. What are we looking at from, does Canada even hold a much percentage of your portfolio? So maybe just give us a breakdown globally by region.
Yeah, for sure. It's about 50% invested in the United States. I think the United States is obviously one of the more stable regions in the world, pretty comfortable with the currency risk. And it's where you're going to find the best regulated utilities, in my opinion. As you know, I like that group, as well as renewable power opportunities. With the Inflation Reduction Act that was passed this year, I think surprisingly, the U.S. has taken the leadership on the climate change file after woefully lagging other jurisdictions. So they've made it very, very lucrative to develop renewable power and be a regulated electric utility. So that's a good chunk of that 50%. Almost 40% of that's regulated electric utilities. The other is one cell tower company and a couple of rails. Then 20% is invested in Canada, roughly. So that's some renewable power companies, one rail and one pipeline. And then the remaining 20+% is mostly in Europe. So we've got all of our airports and 2 of our 3 toll roads are European. The last toll road, which is about 3%, is in Australia. So it's kind of like 70% North America, 30% rest of the world.
Great. Thank you for that. Do have a question here from someone who's watching right now. It's about something in that space. Algonquin Power was long considered a safe utility play, and it's obviously tanked. Are they in the regulated electric space? And if so, is this a sign of things to come for other utilities, private and public?
Yeah, that's a great question. That's not the lone sort of canary in the coal mine either. Emera was hit by I think some political headwinds recently, where the province of Nova Scotia said they can't raise utility rates for the next 2 years because consumers need to be able to deal with inflation. So they basically pulled the trump card against the regulated utility commission and made it law that Emera can't raise prices in Nova Scotia. And then another company, Dominion Energy, faced the same problem in Virginia. So customer bill inflation and therefore blowback from politicians and regulators is, I think, the number one risk, and you need to be mindful of that. I would say, first of all, we don't operate in or invest in states where the regulation is overly tough. Like regulation, supportive, and what I've found is sustainable, firm but fair regulation tends to be where you want to invest. So nobody gets everything that they want. Everyone has to sacrifice a little bit, and that forces the management of these companies to hustle, right? So they got to please the regulators, and they got to find ways to cut costs and actually run a monopoly like it's a competitive business. We like that sort of environment, but it is a risk factor that we need to be mindful of, because politics can change. Right now it looks okay, but that's something you got to be aware of. I would say Algonquin, though, is a bit of a unique animal where they had always promised investors a 10% growth rate, and in order to do so, they had to be serial equity issuers, because these companies don't naturally go. A regulated electric utility does not naturally grow at 10%. They naturally grow at 4 to 6%, based on the internal cash flow and their ability to keep their balance sheet, clean. Right? They can raise a bit of debt, retain some cash, reinvest, repeat, etc. Algonquin was saying they can do 10%, and now they got themselves into some financing problems where they're basically going to have to renege on that promise, or issue equity at prohibitively punitive levels. And so Algonquin's a bit of a unique animal in that way. They've always been aggressive and pushed the envelope in terms of where I think a utility should go in terms of prudence and discipline.
Thank you for that answer. So.
Actually, I've got a question. Can I jump in for one for you, Frank? Obviously, what you're doing in the portfolio is primarily publicly traded securities. These are companies that are listed on the exchange, and one of the differences amongst the institutions is kind of more private companies. But I think one of the things we've seen over the last few years is private takeouts of publicly listed companies. So could you talk a little bit about that and how that's a bit of a tailwind? Is that appetite still out there going forward potentially? And what does that mean for some of your holdings in the portfolio?
Yeah, still very much there. The good news is the KKRs and the Blackstones and the Brookfields of the world raised tens of billions of dollars for their private equity infrastructure dedicated mandates. And I think when we talk about quote unquote dry powder out there in the private equity world just dedicated to infrastructure, I think it's north of $100 billion across all mandates, sovereign wealth funds, etc. That money does have to get put to work, and so that's the good news. The bad news is, with higher interest rates and these guys' dependence on debt financing, so it'd be high yield debt financing to get these deals done and make their IRRs and all that. You've seen private equity like transaction multiples come down fairly noticeably. So listed valuations have come down too, so it's still a premium. But I think the read through from the private market is, yes, it's still a premium. It's no longer 25-30%. It's more like maybe 10 to 15, even maybe 20% premiums, and that's after the listed guys have sold off a bit. I don't think you can't really do a read through between a private like a Blackstone's transaction multiple versus a listed multiple 1-for-1, because Blackstone owns the company. So it's a majority interest. and it's highly debt financed as well, versus a listed valuation reflects a minority stake for a company that's well capitalized. So there's some reconciling you got to do, but I guess the point is, yes, there is still a premium. Yes, there's still going to be a lot of demand. It's just the price has come down because the cost of debt has gone up.
Nice. Do you have time for one more question, or do you have to get going here?
No, I'm all yours.
All right. This is my own question. Just interested in when we talk about kind of the ESG movement and, somebody like Mark Carney, really pushing hard to have financial insurance companies not fund certain projects, but yet he's involved with Brookfield trying to get his own projects off the ground. I mean, is it difficult for a manager like yourself to try and gauge who's going to get squeezed out by the regulations that steer the business to another piece of the pie? Like, I find it a little bit conflicting that we have these people pushing the world one way and trying to get institutions to stop financing certain projects, but yet they want their projects financed.
Yeah, that's a dangerous question, because I got my own feelings on that. And I have to be careful how I express them.
Sorry to put you on the spot, Frank, on that, but yeah.
Well, so first of all, I would hope that certainly in something like ESG and climate change related discussions, that the fanaticism gets out of the equation and common sense and fair market, open market principles kind of take over. And unfortunately, right now, I think things have kind of gone off kilter, right? And the energy crisis, as unfortunate as it is, has made people realize, logic, reason, and common sense need to play a part in providing an energy solution. And it's going to take time to transition. We don't fully know exactly what that transition is going to be like, or what kind of a place each of the actors have in that transition. What we do know for sure is, fossil fuels are going to be with us for quite some time. They're going to definitely be a part of the solution going forward. There's ways to make fossil fuel production and consumption cleaner, and it is just a necessity. It's pervasive in society, and you can't just it's not productive to blacklist entire industries for something like that. You produce fossil fuels, I'm not going to finance it. That makes you're not providing a solution. You're creating a problem. That's my personal view. And I think we're starting to realize, with some early signs from even the most extreme views, like in Europe, they didn't even consider nuclear to be a viable solution for energy. And not only have they now put nuclear back into their taxonomy, but I think they're also officially not vilifying natural gas, realizing that they actually need it. So let's be practical, and we can find ways to capture carbon and not get people fussed about how they're polluting the environment by using fossil fuels. So I'd like to think the fair market value, the fair market open market principles plus necessity will come together and we'll come up with more sensible ways to address this problem, and get rid of things like the hypocrisy that you mentioned. From my point of view and how I do my job, I didn't look at it from a social or from a political or a moral standpoint. I look at financial statements, and I look at returns, and I look at how to make money. And I also would rather be the disruptor versus the disruptee. And because of all that kind of channeled me naturally into the renewables space. Anyway, right? So I think our infrastructure offering does and will score well on ESG metrics on all three letters, like social and governance. We obviously make sure we buy good corporate citizens regardless, right? I mean, we're not interested in child labor or other egregious sort of misbehavior out there in the corporate world. We only buy good corporate citizens, and on top of that, I think I can tick the E box or the E letter now too by having more of a renewable power type of a bent in this fund. But it's that I wasn't steered that way out of social pressure. I was steered that way because of the things that I said. Good returns with being the disruptor versus the disrupted. So yeah. Hopefully, common sense will prevail in all this, and we can put this kind of sensationalism behind us.
Thanks for the great answer. Yeah. I think we can let Frank go here. If that's
Frank,
all good. We don't have any more questions from the gallery. So
I just want to say we're going to continue on in the podcast here with Jeff. He's going to hang around with us to talk a little bit more about the fund. But Frank, in sensitivity to your time, we'll let you leave us here today. But we want to first thank you, of course, for joining us and taking time out of your day to share your thoughts with us around infrastructure and investing in it. So we really appreciate you being here, and thank you again.
It's certainly my pleasure, and happy to be here and to contribute any way I can.
Right on.
Thanks, Frank.
Thanks, Frank. Great to see you. Be well.
All right. Well, that was somewhat eye-opening, I guess. It's great to get a picture around what infrastructure is for those who are interested in the space, because I guess some people could be pigeonholed into what they believe infrastructure to be. So Frank gives a great picture of what it is. So.
Yeah, I think it's one of those topics everybody has some idea, but the ideas sometimes are a little bit different in terms of what exactly does that mean or what's included. And as Frank mentioned, sometimes those definitions, and we've seen it in the business and in some of these solutions, sometimes that definition gets a little stretched and a little stretched and a little stretched, and next thing you know, you're an infrastructure company that or an infrastructure product that owns something in the high tech space that has nothing to do with it, and it's a loose connection there. So it's nice to know he's got that conviction and that discipline and that philosophy to really kind of stay in his lane. And sometimes, as you guys know, that's difficult for even professional investors to do.
for sure it is. I mean, we've owned different holdings for our clients that have slipped significantly to the point that it changes the real core sense of the fund. I mean, it just messes up certain things, and especially when we're balancing between what we consider to be a lot of different peer pieces, it starts to meld into another piece, and that's not good for the way we want to run money. So yeah.
But we have some questions. For
I
Jeff
got a question for Jeff. Maybe.
Fire away.
So he talked a lot about publicly traded companies. Is there any privates in there?
We do have the ability to do some private companies. It's fairly limited. I think as per our mandate, we're restricted to about 10% maximum, and in all likelihood, we're less than that. I mean, one of the things that's important to us is just the concept of liquidity, and all of our vehicles are dynamic by structure and by design are designed to have a daily market, meaning we're valuing our companies every single day. And if a client decides to transact, whether that's a buy or a sell, that they know that they can do that on any given day. And certainly some securities, maybe trade more or less than others, but at the end of the day, we strike a NAV on everything at the end of the day, and so we have to manage and conduct ourselves accordingly. And what's interesting, if you speak to Frank, and you take a look at kind of historically how, at least in the infrastructure space, public markets have tracked private. At the end of the day, by the time you account for some of the fees and some of the liquidity, you're getting pretty similar results over time. Certainly, there's room for privates as well, but we'll stick to the public side.
So would you categorize the fund as an equity fund or an alt?
Well, yeah, that's a good question. I think generally it's publicly traded equities, so I think you treat it as an equity fund. But of course, when you're constructing a portfolio of equities, you hire different managers, different solutions for different pieces and different objectives. So certainly there are times where infrastructure may behave a little bit differently than the entire market, but I feel a little more comfortable as an equity. Yeah.
We talk sometimes about investing like a pension plan.
Yeah.
Trying to create your own account so it's like a pension.
Mm-hmm.
What do you mean by that? When you talk to a client or you talk to guys like us about investing like a pension?
Yeah.
What does that look like?
Yeah, great question. And I think probably one of the easiest way to understand the concept is with an example that everybody would probably be familiar with, but maybe not the underlying. And It's our own pension plan. It's the Canada Pension Plan, CPP, the investment board. And what's interesting, you can do a really interesting study on how they've changed over the years. So if you go back in time to the mid to late 90s, there was actually a concern over the future viability of CPP and whether it was going to be around for future generations. And I think at one time they actually did an actuarial analysis, and they were concerned that there'd be nothing left by 2015. I think was the figure that they threw out, and that was in the early to mid 90s.
Yeah,
so
I remember in my early career writing financial plans and asking the client, "Do you want me to include CPP?"
Yeah, I mean it's crazy to think about now, right? But that was a legitimate concern. So if you go back in time to that period and you took a look at what CPP was doing, it was fine originally being invested in very conservative instruments, mostly in cash and Canadian government bonds. And that was fine because you had more people paying into it than there was drawing on it. And then, of course, you have this demographic wave of baby boomers starting to retire. And that's what prompted them to take a look at making some changes and going, if we don't redesign this, we're going to be we're going to be sitting here with empty pockets in a couple of decades. So, of course, they made some changes to increase contributions and adjustments along the way. But one of the things they really did was obviously establish the Canada Pension Plan Investment Board, an arm's length manager of the assets. But they did a complete redesign and overhaul of how they built that investment portfolio. And so I actually have a couple of printouts from annual reports from CPP. So if you go back even as recent as 2001, and if I take a look at how the Canada Pension Plan invested their money, 73% was in bonds, mostly government bonds, 13% in cash, and 14% in equities. So you can imagine, how tough it would be to generate an adequate rate of return. Now, obviously, rates were a little bit higher than they are even now, but still. And of that mix, about 70% was invested in Canada, and 30% was invested abroad. And they said we need to make some serious changes to make sure this thing lasts. Well, fast forward to today, I've got the 2022 pension plan results and construction in front of me, and it is a complete 180 of what they used to be, where so we've gone from 70+% in bonds plus cash. Right now we're looking at kind of 20 to 25% in fixed income. That's mostly credit, so lending to companies. Only 27% in publicly traded stocks or equities, 32% in private equity. So a meaningful change there. Actually, I was reading through the 2001 report, and they were just starting to mention their interest in private equity. And today it's now a third of that portfolio. And then, to our topic today, 9% in real estate and 9% in infrastructure. And if you take a look at now, so the pension plan itself has gone from something like $5 billion in assets to over 500. It's actually one of the better pension plans, sovereign pension plans in the world. And they've reestablished their guidance that the portfolio is going to last for another 75 years or more. So what a complete turnaround. So I think that is just a great example of how do you create a pension plan? And I think for those of us as individual investors, we should be maybe not doing exactly what they're doing, but it's a clear difference from what some Canadian investors are doing. And so how do we find that middle ground?
Yeah, I think it's a great point. Tyler and I manage some pension plans, so we have spent some time trying to almost mimic kind of CPP in the sense that how do we get some of the private equities, private debt in there, infrastructure, all of these pieces we're talking about. And we've naturally kind of started applying that to all of our client portfolios. And a lot of that comes with alternatives, if you want to call it that, but they're less liquid. And they're not priced as often as normal funds. So, it's a trade-off, but, we have to look at it from any client. Is a client going to need 80% of their money tomorrow? If we have 20% in alts that they're just not as liquid as you would want them to be. I mean, we can get at them. It take 60, 90, 120 days. Maybe they get gated. There's all sorts of
That's right.
Problems with that 25 to 30%, 20 to 30% we use for that. But, the level of volatility that's come off the table because of using those is extreme. Yeah. And we found that kind of gives us more of the model of CPP by using those pieces. You give up a bit of rate of return, but, I think we've stopped trying to measure ourselves against other pieces. It's impossible to compare. So, I mean, we created our own benchmark for equities. We basically just say 50% the TSX, 50% the MSCI world. Doesn't mean we're 50-50. We could be 90% in the MSCI, around the world. But that's just something that at least we can have a discussion about how it's performed against that part. And so by doing that, we can at least show, okay, based on those parameters, we have a 90-something% capture rate on the upside and 70% on the downside. So to me, you stop chasing rate of return sometimes when you can take that much volatility off and get a pretty decent rate of return that's actually close to the index net of fees. But it's boring for the most part. I guess who was it?
Boring is pretty good these days.
Was it David Chilton that said that? This is not the kind of thing you're going to talk about at cocktail parties, your Canadian equity fund.
Yeah.
I mean, talking pensions, the teachers weren't they large holders of FTX there? Something like $95 million.
Dollar terms large. Thankfully for them, percentage wise, I think it's a small stake. But I mean, there are some major institutional investors that. But when it comes to investing, to your point, just kind of talking about liquidity, it's really everyone focuses on returns, but it's really about balancing risks. And there's no such thing as anything being risk free. And sometimes I get raised eyebrows and they say, well, what about a GIC, or sitting in cash? Well, that's just a different risk. And the risk is you're not making enough, or the risk is you're locked into that. So really,
your risk is you're covered only for $100,000.
Another risk, exactly.
So you could have a pool of GICs from different institutions, your diversified institutions, and there is a trade-off on all of these things. Liquidity for safety, and maybe liquidity for better yield. No one can have risk-free capital. It doesn't not even a savings account qualifies for that anymore.
Doesn't exist. So it's how do you find all these solutions and combine them intelligently to provide that outcome that's going to meet objectives and through the various tools, through the various cycles, and of course there's always that emotional and behavioral aspect as well of I just can't handle this. So which is a nice benefit of having the alternatives. Not as rocket ship on the way up, but steady and stable, and those daily fluctuations sometimes go a long way in ensuring people meet those long-term objectives.
And that comment there about clients when they kind of hit that spot and like, okay, this isn't for me. And we've all gone through it as advisors. But less frequently because of the way we've redesigned our portfolios over the last 7 years. I just remember 08, 09, and, a lot of the comments were, well, I didn't know I had this, my risk was this high with this kind of money. This isn't what I thought of when I thought of the kind of risk, right? And you're like, okay, well, what are your options? We sell it and change your risk, but then you don't get much of the rebound.
Yeah.
And most people are like, okay, well, when things get back to normal, then I want to redo my portfolio. And it gets back to normal. You go to redo the portfolio. What do they say?
Yeah.
No, I'm comfortable. This is great.
Everybody loves the risk on the way up, and then on the way down, it's a very different story. But of course, we can't predict exactly what's going to happen. So we need to kind of have that all-weather portfolio.
Yeah. And I think infrastructure, like you said, you're going for steadiness in long term, and that's some of the pieces that they're not. It's not sexy. It doesn't appeal to a lot of people.
Yeah.
But in a long-term portfolio, it's a great little chunk to just kind of take the volatility down. You probably just alone it has good upside capture and low downside capture just from that by itself. So.
Yeah. I have a saying: when you start to see your investments on the cover of a magazine, then you should be concerned. So unsexy and boring is a good
true.
thing.
Yeah. I should mention to our viewers, you're welcome to post any questions in the question and answer box. I think that's what it's called.
We got about five to 7 minutes left.
Left here. We do still have some questions for Jeff that we can ask him. But if anybody out there wants to voice a question, we'd be happy to relay it here to our panel. So we talked about this stuff being like a pension, Jeff. We see a lot of portfolios come across our desk that we have to analyze if we're trying to bring a client on and taking a look at positions that, obviously we don't manage yet and portfolios that have been constructed outside of our team. And we're not seeing a lot of stuff in there like this. Why aren't more Canadians investing like this? Is there barriers to entry? Is it advisors not adopting it? What do you see?
I think it's a bit of both. I think there's good reasons and bad reasons, and maybe some of the good reasons or even legitimate reasons are, some of these products are relatively new. This is stuff that wasn't always available to investors. So I think anytime you have something new, you want to take a little bit of time just kind of understanding how it behaves. In previous times, some of these solutions were only available to people that were committing $1 million, or maybe, and so you were locked up, or maybe the price was a little too high what you were getting for what you were paying. But the good news for investors is these things really are available now. You're not being forced to be locked in as long. Fees are naturally coming down. So it's a very competitive and great environment for investors to look at using these. Quite frankly, some advisors just haven't done their due diligence. I know for myself, when I'm working with my advisor, I want them uncovering every stone and rock out there, looking for the best opportunities. Now, that might mean we're probably going to say no 90% of the time, but I want to know they're at least doing the work and doing the diligence to figure out or even follow some of these things for a number of years. So I think it's been a bit of a reluctance to do the work. We've also most recently, especially the last couple of years through 2020 and 2021, hey, you could go throw darts at a dartboard and buy something high risk with no cash flow and make 100% in the matter of months. So all of a sudden, an alt doesn't seem too enticing in that type of environment. But now you get back to where we are and you go, okay, I see how some of the stuff has held up well. We need to dig in. So I think it's just a matter of just, becoming more prominent in the industry and kudos to yourselves for doing that work and being willing to put in the time to understand what's available to your clients and your investors and make some of those solutions available, and we see it as a big growth market for the industry overall.
Well, I mean, your comment too that all of these pieces are available. I mean, you can technically, as an investor, replicate CPP in your own portfolio now.
Absolutely.
With liquidity.
Yeah.
I mean, not the daily liquidity like a straight up fund, but it's there. Well, there's tons of daily liquid alts as well. I mean, we do in our alt portfolio. I think we have maybe four positions that are, I call them illiquid, 30-day or quarterly type redemption, and probably 4 positions that are daily liquid. They're liquid alts. And so it's a combination of, even, as you say, you've got to be looking at these things. Someone's got to be paying attention. I mean, we get so many of them across our desk. Yeah. I mean, in the alt world, it's almost like everything that doesn't fit an equity or bond. There you go.
Yeah.
And I always joke 95% of it's utter garbage. Maybe it's 90. I don't know. Yeah. I'm being a bit facetious when I say 95, but there is some funky stuff in there. I mean, you got royalty funds, music royalty funds now. Like you have all of these pieces, real estate that you couldn't get your hands on. Yeah. I mean, you think of if you're a real estate investor, if your thing is, I don't like the stock markets, I like to be able, some people want to drive by and look at the light on in the house and go, I own that place. And, they don't want it on a statement, but they want the sense of owning all this real estate. I mean, when you're done with that, you still love real estate. What do? You have to then sell everything off, just like a farmer sells his farm, a business owner sells their business. Well, a business owner could just sell their business and just divert all their money into private equity if they want to just own businesses. Yeah. A farmer can, buy into a farm fund. Yeah. That's diversified cash crop across Canada, United States. And the same with a real estate person. They can buy a real property fund that's truly, it's not buying, Brookfield's probably not the right, it's not buying a stock that's publicly traded because it's just as volatile as the rest of the stock. You're buying a pool of money that just buys these things, real estate across North America, for commercial, residential, everything. So, I mean, there's really cool pieces there. It's just how do you fit those in? And this, if you want to think about it, this is how super wealthy people invested their money through family offices. They just had all these sleeves and they would have a professional for each one of those pieces.
Absolutely, yeah.
Now it's available on the retail side. Yeah. So, yeah, you have to kind of...
It's become quite boutique, right? You can, like you say, buy a sleeve of whatever you might be looking for. Sorry to our sound guys for hitting the mic there. But So what should advisors and clients be looking for when they're exploring this space? Is there some pitfalls, some traps that we should be aware of?
Well, I think it's, what's your objective? What are you looking to achieve at the end of the day? I mean, the silver bullet investment that goes up, twice the market in good times and doesn't go down in bad doesn't exist, or it did, and it was Bernie Madoff's portfolio. So it's really an understanding of, am I buying this to supercharge returns? Okay, well, that's fine as long as you understand that and recognize that there's going to be the other side of that. Vice versa, I've seen advisors commit to, kind of more of a boring, steady Eddie, type of alternative strategy, but ultimately didn't hold it long enough because it wasn't going up enough in good markets. So there's no such thing as that, having your cake and eating it too in that space. It's am I buying this for cash flow? Well, maybe then I'm sacrificing a little bit of growth. If I'm buying it for growth, I might not have as much defensive feature. So I think it's just an understanding of what am I after and what am I not sacrificing, but what's the other side of that story? Because there always is, and you just have to be realistic. So it's understanding kind of what's available in that space, and now that I know how I expect it to behave, is it doing what it's supposed to do? And then that's kind of the second level of the things that you guys are doing on a daily basis when it comes to monitoring and oversight and sitting down and meeting with the managers and having discussion to make sure it's doing what it was proclaimed to do. So that's really it. It's just awareness of, what do I ultimately want out of this?
It's a little different, I think, not that we're completely focused on the alt space, but, when you talk even the privates, unlike, we could buy Dynamic, Power Canadian, but we wouldn't go buy 6 Canadian equity funds because we'd have overlap.
Yeah.
We'd have that, but we could buy 5 private equity funds and not have that overlap.
All very different, potentially.
That's right. And probably, I mean, let's face it, something that's offering memorandum product compared to a publicly traded, I mean, you're going to get some hiccups in there sometimes. So, I'd rather own 5 of them than 1 of them. But you got to find 5 good products that fit the bill,
that
right?
Takes some work.
Right. And the market's not quite there yet for all those pieces, but it's getting there. And that's what's kind of interesting for that.
Yeah,
so,
absolutely.
Yeah.
Well, that's great, Jeff. I don't think we have any questions to clear up from our attendees, so we're kind of hitting the end of our time period here. So thank you very much for joining us, Jeff.
Thanks for having me.
We look forward to having you back again. I think you're one of our repeat performers here. So
I made the cut for a second round.
I think
you're the first second guy in the studio, though.
Well, in studio first, for sure. Yeah, so we've obviously getting through the tail end of COVID. So thanks again, Jeff, for being here. And to our viewers, if you want to learn more about us, head over to towerwealth.com and please follow us on social media. Thanks for tuning in.